Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I tell.
All right. My name is Mark Eitel, host of the Mr. Mortgage Show, and you heard the man. We do put the fun in funding. You're in the right place if you want the mortgage and real estate news that you need to make better real estate decisions for you and your family. Dom and I do this each week right here, same time, same station. And as always, it is our goal to give you the real data, dig past the headlines, and give you what you need to make those decisions. So this was a crazy week in real estate and mortgage news. We had the Federal Reserve come out on Wednesday and raise the overnight interest rate by 75 basis points. And we all saw the reaction in the market because of it. It was quite interesting. There's some speculation that they leaked the news early in the week so the market would have a chance to digest it because it was a more aggressive rate hike than originally anticipated. And we saw that. We saw the bottom fall out of the stock market. We saw mortgage rates jump significantly in the Friday, Monday, and Tuesday trading days. And then after the Fed announced the 75 basis point move, rates all slid back down just a little, not enough for you to feel anything, but they moved back and we all thought we were going to, stabilize. And then Thursday morning, they were off to the races again. So before we dig too deep into any specific headlines, I want to just address the elephant in the room and what does this mean to you as the consumer, and then specifically tie it into real estate. So what that 75 basis point move is going to do for you is it's going to increase your payment on any credit card balances that you have because they're tied to the prime rate, and all of that just jumped 3/4 of a point. So any revolving debt that you have that's on an adjustable rate, like a credit card, a home equity line, all of that's going up, which is tough right now because gas keeps going up, food keeps going up. I mean, I paid over $5 to fill up on the way in this morning. It is nuts out there. And this is just one more swing of the bat, wallop in your checkbook. But it doesn't have a direct correlation to real estate. Now, what it may do is start to cool some of the demand, and that's what they're anticipating in real estate because it's becoming more expensive to borrow. But we've got some great strategies around that, and we've got some great data to support some of the thoughts around real estate and how real estate may be a great hedge against inflation and still a good opportunity to make a purchase even now. All right, I want to dive into that. The rate jump is slowing demand, right? That's a preconceived notion out there right now. There's a lot of headlines surrounding that. And that's true. It is slowing demand on the real estate side a little bit. There's a segment of the market that was barely qualified at 3%, and then they readjusted their target home purchase at 4 and 4.5%. They were hanging on to the opportunity at 5%, and maybe at 6%, they're no longer qualified. So there is going to be some easing in demand, and we're already seeing a little bit of that. But the biggest component that is overheating the real estate market is the supply. There's just not enough supply in the market right now. And I want to touch on a great interview, and I'm going to pin it to the Facebook page. Go to Facebook, search the Mr. Mortgage Show, and you'll find this article there where they dive deep into the supply side pressures on real estate. And we're going to cover some of the points, and you've heard me cover some of the points in the past, but I want to acknowledge that there is a little bit of slowing in demand. However, demand is still outpacing supply significantly. I talked to real estate agents from all over the country in preparation for the show and in running my mortgage practice. And in all areas, they're still seeing a lot of demand. I talked to a gentleman in Arkansas. He had an open house last weekend, and he had 5 qualified offers by the end of the day following the open house. So logic dictates there's still 5, at least for that home in that market at that price point, which I don't know all the details of. But that specific example, there were 5 times the demand than supply. So until we see that shake out, there's just not this bubble bursting market crash setting up that everybody's anticipating. And it's interesting. We go back to the mental frame of reference to 2008 when we saw the housing crash. And everybody, it's interesting. I don't think we're afraid of the future. I think by nature we're not afraid of the future because we don't know what it holds, but we create a future based on past experience. And the most recent frame of reference to an overheated housing market that everybody has is, 2008 through 2010 when the market crashed. But it was for very, very different reasons, which we're going to get into in this week's show, and I'm going to cover here in a minute. So I encourage you to look past the headlines and realize that, yes, rates are going up and buying demand seems to be slowing a little bit, but it's still outpacing supply. And I shared it last week. In a higher interest rate environment, there might even be more supply pressure because who wants to sell their house right now? If they've got a ton of equity and a low interest rate, they may just renovate. They may sit tight, which is going to put more pressure on new housing inventory coming to the market. But here's the big thing that I really found super interesting. And you've heard me talk about it in the past. Last time it was speculative buyers that drove the market because it was false demand. One person was buying multiple properties to flip. So one guy held 10 properties, and now one guy is buying one, maybe a second property. So a very different ratio of buyer to available properties. But this was something I found super, super interesting. In 2005, before I get into that, let me explain one thing. What a housing unit is and what a new household is. So a new housing unit is any home, apartment, single family, townhouse, anything that's delivered to the market. So a new construction dwelling is considered a new housing unit. Now, a new household is, think of your child, they graduate, they move out, they get their first apartment. That's a new household. A new household was created. Your kids move out and the boyfriend and girlfriend move in together. That's a new household. So someone establishing their first place of their own. Husband and wife get divorced. One of them move out and get an apartment or buy a house. That's a new household. So a new housing unit, a new dwelling that's delivered to the market, new household is a first-time established residence, if you will. So the U.S. averages 1.2 million new households a year, meaning people going out on their own for the first time. In 2005, we delivered over 2 million new housing units. So over 2 million units were created, over 800,000 more than necessary. So they were being purchased by speculative buyers. Now, right now, today, we're delivering about 1.2 million units, and we have higher demand than ever before. So oversupply drove the housing crash last time. And you hear me say it all the time. I talked about the bamboo toilet paper in the pandemic and supply and demand, how it drives the market. So you can see, here's one more example, that in the housing bubble of the early 2000s, there was a ton of supply coming to the market, but nobody noticed it because people were using these liar loans. They were lying about their income and lying about their assets and going out there and buying, multiple properties to flip. So there was what's the word I'm looking for? Artificial demand created with these speculative lending products. And the market absorbed that 800,000 plus additional units to market. Right now, today, we're barely delivering enough to an average new household creation number, historically, that 1.2 number. And arguably, that's higher now because we have pent up new household creation demand because a lot of people moved into their parents' house. They moved back home during the pandemic and they're itching to get back out there. So a tremendous amount of demand exists against the supply, and that's what drives pricing and values in housing, not the interest rate. So don't get alarmed by the Federal Reserve. It's going to do what it's going to do. It's trying to quell this crazy inflation. It wants to quell the $5 gas, the $7 bacon. You need to focus on budget and know that buying real estate in any market historically, with the exception of the Great Recession, has made sense. And on the other side of this break, I want to dive a little deeper into that. And as always, we're going to get to your questions. I encourage those questions. Just give us a shout. 561-291-8569 is the Anytime hotline. That's 561-291-8569. Dom will get your questions on the air. Or shoot them to us via the web, www.mr.mortgage. That's mr.mortgage, never a .com. And we're going to be right back in 2 very short minutes. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel, host of the Mr. Mortgage Show. Dom, my producer, and I do this each week right here, same time, same station. And you heard me before the break. Encourage your questions. Go ahead and call or text those questions to 561-291-8569. That's 561-291-8569. And we affectionately call that the Anytime Hotline because during the week, that'll push to my office if you need us. So 561-291-8569 is the Anytime Hotline. And call or text your questions. And you don't have to get on the air if you don't want to. Dom will just write your question down and read it for you. But yeah, we always encourage your questions. We're happy to answer them. And then the website is that's the Facebook page. Go to Facebook and search The Mr. Mortgage Show, and you'll find all the data that we use. And I'm going to post that Bloomberg article because it was truly enlightening to the Facebook page. But go to Facebook and search The Mr. Mortgage Show, and you'll find a bunch of articles and charts and data and cool stuff and a little bit of behind the scenes with the show. There's some interesting stuff there. And then lastly, visit the website, mr.mortgage, neverever.com. Just go up in your browser, type Mr., hit the little dot, type mortgage, and hit enter, and voila, we will magically appear. So, hey, listen, I just want to finish up my thoughts on that economic data that I was sharing before the break, and then we're going to dive into your questions. So basically, to summarize what I'm saying is the last time we experienced this, we had a larger number of new housing units being delivered to the market. The last time we were in the 5 and 6% interest rate environment, we had almost 1 million more units coming to market every year. And that's not including resales. Those are new homes being created each year. So a tremendous amount of supply is where the market tripped over itself last time. And then, the subprime crisis and the secondary market liquidity. I'm not going to geek out on that during the show. I would love to talk to you off air about it if you'd like to. But that was what caused the downward cycle, if you will. So very, very different. And lastly, I'm going to share this. It feels the same. I'm not discounting anybody's sense of perception. This market feels very, very similar. People are overpaying, overbidding, waiving appraisals, waiving inspections, and you've heard me speak against that for months now if you've been listening to the show. But the best way I can describe it or explain it, and again, I'm an old Florida hillbilly, so I have to break it down to basic explanations. But if you were on top of a mountain and you aimed your car downward and you put it in neutral and turned the engine off and just started going, somewhere along that journey on your way down, you're going to be going at least 80 miles an hour. And if it's a straight shot, you're going to be flying. And if you roll the windows down, your hair is going to be blowing. You got the exhilaration of 80 miles an hour, and you've got that sensation. Now, if I leave here this morning and get out on 95 and roll my windows down and go 80 miles an hour, well, guess what? It's the same sensation. I feel the same. The wind's the same. I'm flying down the road, but guess what? They're for very, very different reasons. Different influences are causing that experience. So, and one is far more dangerous than the other. I can't imagine trying to stop that car at the bottom of the mountain if it's not even running. But my point in that is, yes, it feels the same. We've gotten here very, very quickly, but the fundamentals of the market, and I know that's so overused, but the fundamentals of the market are so very different this time that my advice, my suggestion, and my practice personally, what I'm watching, because I'm no different than you. I mean, we have a house, we have a mortgage payment. I'm a lifetime member of this community. It's important to me that people it's important to me that people profit from real estate and aren't harmed by it. I'm no different than you. I'm watching this every day, but what I'm watching is the unemployment rate, and I'm watching supply and demand, and I would encourage you to do the same. And lastly, focus on your budget. If you're paying $2,500 a month in rent, why go pay $2,500 a month for a mortgage? Your landlord's likely to increase your rent again next year, and that mortgage payment with a fixed rate mortgage product is going to stay just about the same with the, slight increase in taxes and insurance once in a while. You're controlling your destiny if you buy real estate, and you're building equity. So that's it. I'm going to get off my soapbox. It's important to me just to share that message because I don't want people to get scared in the corner. Historically, real estate has done well in a recession. Historically, real estate has done well despite interest rates. So that's it. That's the end of my encouraging words. I'm going to post all the data to support those thoughts on the Facebook page. But now we're going to get to my favorite part of the show where we get some of your questions. And let me throw it over to Dom to see what questions we have.
Paul sent us a text. We're actively looking for a house to buy. Are there any strategies or programs for buyers to fight these rates?
Hey, Paul, great question. And I get it. It's frustrating, especially if you've been looking for a while. So there are a couple of strategies that you can deploy differently. So one is a rate buy down. And you can buy your rate down in any market. You could have done this when rates were in the 2s if you wanted a 1. You can pay a fee to the bank to buy the rate down. Essentially, consider it like prepaid interest. But yes, you can buy the rate down. We're seeing that more and more. It's becoming a thing again. And you can do it one of two ways. You can negotiate a discounted sales price. So I think I did a podcast episode on this a week or so ago where we talked about a person who had a $465,000 house that they were looking at, and they offered $450,000. The seller agreed. Well, rather than write the contract at $450,000, they're taking that $15,000 and buying the rate down a percentage point. So instead of 5 3/4, they're going to pay 4 3/4, and the seller's doing it for you, which is awesome. So that's one strategy. You can buy the rate down. You can also do that if you were one of those people who were willing to go over asking price last year. Don't forget about those people. They were thinking $20,000, $30,000, $50,000 over ask. And those same people are thinking now, does it even make sense to buy? You could take some of that Bitcoin money that you have stuffed in the mattress and buy the rate down with your own money if you wanted to. So rate buy down is a real strategy. There's several ways to facilitate it. I love the idea of the seller paying it for you and it not coming out of your pocket. And I'm happy to talk you through that. If you want to call the office during the week, you can use the Anytime hotline, 561-291-8569. And then there's another strategy, adjustable rate mortgages. And before you jump up and down and say adjustable rate mortgages broke the market last time, they did, but they were a different adjustable rate mortgage altogether. They were dangerous loans, interest only, periods with big prepays, big adjustment swings. People didn't have to disclose income and assets. They were dangerous. These are very, very different loans. They're fully amortized. They're fixed for 5 years, 7 years, or 10 years. Then they only adjust once a year. There's pretty moderate caps in the adjustment, and you have to be fully underwritten to qualify. And as I mentioned, they're fully amortized, meaning you pay principal and interest each month. But there's opportunity to get a start rate for the first 5, 7, or 10 years significantly lower than where market rates are now. So to answer your question, Paul, I would look to a rate buy down strategy or an adjustable rate mortgage, and I'm happy to answer any questions that you have regarding that and dive deeper with you should you wish. So let's see what else we have.
Frank emailed this one. Frank's asking, I know the rates keep going up and the Fed says more hikes to come. Do you think this is going to finally cause house prices to drop? I don't want to buy in a bubble.
Hey, Frank, that's a great question. And you heard me reference it in the opening segment. I don't think it's a bubble. I think the market got here real quick. I think we're overheated. I think some neighborhoods are going to pull back a little bit, but I don't think there's a bubble bursting. And for all the reasons I shared opening the show, supply, demand, if you check out the Facebook page, I have all of those videos posted there. Or, you know what, go to the podcast page, which is themrmortgageshow.com. We do a daily dose podcast, which is, usually 5 minutes, once a day on one topic. And then Dom and I, at the after we air the show on Saturdays, it's recorded and Dom puts it up as a full podcast episode. So you get a little Mr. Mortgage 6 days a week on the podcast page, which is themrmortgageshow.com. But yeah, I don't think we're in a bubble for all the reasons that I mentioned, which all stem around supply and demand. And I just want to share one statistic to support that. I think the biggest fear most people have is that we're in a recession. And a lot of people don't know what's going to happen to housing in a recession. So I printed out a chart. I posted this on the Facebook page, but I showed the last 5 recessions, the length of the recession, and what happened to housing during the recession and the interest rate hike period. And you can see that in all interest rate hike periods, that home sales volume, right, the number of homes sold went down, with the exception of one period. But home values or prices went up in all of those periods. So check out the Facebook page for that. Go to Facebook, search The Mr. Mortgage Show, and there's a chart that says mixed impact of rising rates on home values. But yeah, hopefully that helps. We're going to be back with more of your questions right after this short break. Sit tight for 2 minutes, and Dom and I will be back. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel. You are listening to the Mr. Mortgage Show, and you are in the right place if you want the information and the data that you need to make better real estate and mortgage decisions for you and your family. And we do this every week right here, same time, same station, and we dive very deep past the headlines to the real data. And I saw some crazy headlines this week. I saw one that said lumber prices, or what did it say? Lumber prices ease amidst mortgage interest rate increase, or something to that nature. And what I found super interesting about that is they're unrelated. But if you read that article, because the article above it said builder sentiment slips, the article below it said mortgage applications fall to their lowest rate in 22 years. And in the middle of that was this lumber and mortgage headline that was kind of squeezed together. And it led you to believe that mortgage rates were causing the slowdown in builders. Which, if you read all of those articles that I just mentioned, none of that's the case. And another article was just published, I think it was Thursday, that said mortgage applications were back up 6%. So, if you're watching the waves and not the tide, you're going to get super dizzy because it's like watching a tennis match. Things are moving back and forth. But the interesting thing is trends march in one direction, even if they go up and then down a little and then up again. So anyway, yeah, we dive past all of that noise and give you the real data. So, and we're to the part of the show where we're answering your questions. That's always my favorite. Get your questions on the air by calling, texting to 561-291-8569. That's the Anytime hotline, 561-291-8569. Visit the website, Mr.Mortgage. That's www.mr.mortgage, or hit the Facebook page, The Mr. Mortgage Show. So on with the questions. Let's toss it over to Dom.
Carl shot us this text. Carl's asking, I want to buy a house that needs some work. The seller can't afford to fix it. Can I roll the repair cost into the mortgage?
Hey, Carl, that's a great question. Yes, you can. There are several loan programs that allow you to roll the renovation costs and repair costs into the mortgage. FHA has one, 203K program. Actually, there's a couple. VA will do it, and then both Fannie and Freddie, which are the conventional mortgages, they'll do it also. So yes, to answer your question, you can do that. I'd love to talk with you, though, just to know what your thoughts are around that. And the reason why is I want to share a story with you. We recently closed a transaction with a buyer who was purchasing a property that needed a new roof. And the seller was unable to put the roof on the property. So we arranged the transaction, and he's going in there and then putting the roof on immediately after closing. So here's what I'm sharing. Instead of the full down payment that he was going to put down on the property, and his thoughts were the same. He wanted to roll the costs into the mortgage, but the interest rate is slightly higher on that type of program, and it carries mortgage insurance. And with the 203K program, you can't get around that mortgage insurance. It lives with the loan for the life of the loan. So long story short, what we did was he put a little bit less money down, so he held back the money he needed to fund the roof out of his own pocket. He's putting the roof on the property, and then as soon as the lender allows, which is somewhere between 6 and 24 months, depending on the program and the lender, he's going to petition the lender to have the mortgage insurance dropped because he's moving into the property with equity. So there's a lot of strategies around this. And then lastly, with those renovation programs, there are some limitations to the amount of money that you can roll in and the type of renovations. Now, some of them are very liberal. You can, nearly do a full reconstruction if the property's, structurally damaged. But I'd love to talk with you more about that, only because it requires a much more specific answer than we have time for on the show. So hopefully that helps. But to answer your question, there are loan programs where you can roll that in. So let's keep the questions rolling, and let me toss it over to Dom.
Gabe emailed us. He's asking, we're thinking a reverse mortgage might be good for us. My neighbor says they are a scam and a bad idea. What is the risk of a reverse mortgage?
Hey, Gabe, I just had a vision of your neighbor walking down his driveway in his slippers, his plaid robe, his boxers, and his undershirt on for some reason, with a big coffee stain on his belly. Maybe an Archie Bunker type. But listen, I'm sure it comes from an honest place that he's telling you that. And reverse mortgages for a long time had a very bad reputation, and they were abused in the past, no doubt about it. So it doesn't surprise me. But I do know that the negative connotation surrounding the reverse mortgage comes from two places. One, a horror story of the past, or a total misconception of the program, just not understanding it. So I thank you for the question. And before we dive into the answer, I would love to talk to you about this off the air, because this topic in general requires a lot of Q&A. It's something to seriously consider because there are some cons. And I'd be happy to walk you through it. But to answer your question, some of the preconceived dangers of, well, let me start by this. Where they were abused in the past were people were encouraging seniors to take reverse mortgages, and then they were also encouraging them to invest that money, which is totally against the law. In 2015, the rules were even changed how you can access that money. So it's almost foolproof, so you can't hurt yourself with it. But in the past, seniors were taking all of their equity out at one time with the reverse mortgage and investing it. And then if they lose their money in risky investments, now they have no equity and no money, which completely defeats the purpose of the reverse mortgage. So as I mentioned, there was a rule rewrite. Say that 3 times fast. The rules were rewritten in how you access your cash, so you can't trip yourself up. But the biggest thing is people are afraid that the bank owns their property, and that's not the case. A reverse mortgage is no different than a normal mortgage, which you may hear some people call a forward mortgage. When you borrow money against your property, the mortgage puts a lien on your property, and that entitles the lender to a first position. Should they need to foreclose, or should you die, or should you sell the property, that lien ensures they're going to get their money back. So with a reverse mortgage, it's just a lien. You borrow the money, and they put a lien on the property. And I'll explain one of the big differences here in 1 second. But one of the other misconceptions is that your heirs are left on the hook if you end up owing more than the property's worth. And that happened to a lot of people in that housing crash of the early 2000s that we referenced a minute ago. People who took reverse mortgages when they had a ton of equity, and then the market slipped and now their property's worth half of what it was. Well, guess what? They owe the bank more than it's worth. Well, here's one really interesting thing about a reverse mortgage. It's non-recourse. There's an insurance component built into the mortgage that insures the lender against loss. So if you run up a balance on the reverse mortgage of $500,000, and when you die, the house is only worth $250,000, your heirs just slide the keys across the desk to the bank, and they cash the insurance policy, which protects them against loss, and everybody moves on. And that even is the case if you have significant other assets. If you have $1 million life insurance or $5 million in other assets, they don't have to pay back that $250,000 in that example that I just gave you. So that's another big misconception. It's a non-recourse loan. There's no recourse that extends to your heirs or your estate once you pass. So that's another big one we get. Number 3 is there's no prepayment penalty. There's nothing preventing you from selling the house. You can refinance a reverse mortgage if you get more equity in the future. You can refinance it into a normal mortgage if you wish. There's really no restrictions. Think of it from the lien standpoint and the restriction standpoint, just like any other mortgage product. Here's the big difference. You borrow that money, but you never have to pay it back. You never have to make a payment. And I guess you do in the sense that when you die and your estate's settled or you sell the property, that's when it gets paid back. So let me rephrase that. You pay it back at the end in one big payment. But that's the thing. It's a big payment because just like a normal mortgage, it has interest on it. So that interest accrues. So if you borrow $250,000, after a period of time, it's logical that you'll owe $300,000. So if there's a con in any of this, I guess one of the cons may be that you're leaving less equity to your heirs. And if your children are concerned about that or you're concerned about that, that's a con to consider. But the reality is this is your equity. You worked your butt off. You raised the kids. You've never had more equity. If you need additional cash flow monthly to hedge against this inflation because you're paying $5 for gas, the reverse mortgage may make sense. And I would love to talk with you off the air because this requires a lot of Q&A, and I'll take all the time you need to answer your questions. So give us a call, 561-291-8569, and that pushes to my office during the week. Gabe, I hope that helps, and tell your neighbor that you're talking to me about it. So we'll be right back after this very short break. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the rec loan he advertises. Long story short, we did a rec refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel. You are listening to the Mr. Mortgage Show, and you are in the right place if you want the data and the info you need to make better real estate and mortgage decisions for you and your family. Hey, and before the break, we were talking to Gabe about his angry neighbor, and I might need you down here, my man. I just looked out the window, and there's an old guy in a plaid robe and his boxers out there leaning against my car. So I think your neighbor heard us talking about him, but anyway, so we're at the point, my favorite point of the show, where we're going to do a rapid round of questions. If you have questions, get them to us via the phone line, the Anytime hotline, 561-291-8569. That's 561-291-8569. And Dom will get your questions on the air. And speaking of your questions, we're going to go through a little rapid round right now. And let me throw it over to Dom.
Jamie just called. She didn't want to talk on air. Her question was, how long is a mortgage approval good for? My agent is telling me I need an approval to even start looking, but I have 4 months left on my lease.
Hey, Jamie, that's a great question. That is a very good question. 90 days is the answer to that. So once we review your credit and we run you through the underwriting system and we issue an approval, what happens is that approval, as long as we continue to keep the file, what I call underwrite ready, or I say fresh, as long as we keep refreshing the file, that approval can live on forever. But the component of it that expires is the credit report. So after 90 days, your credit report is going to have to be recertified just to confirm that your debt, your credit scores, nothing has changed, because all of that is an influencing factor to the report. But here's one cool thing. With your lease being 4 months out, it's about time to get rolling with that, because if you find a property, 60 or 75 days in, you can arrange the closing so that you're still closing on that original approval, but you're not making two payments. You can still make your last lease payment and before you make that first mortgage payment, and not have two mortgage payments on the same month. And I'm happy to explain that to you in detail, but that might be an easy transition anyway from lease to ownership, so you're not doing it on one crazy weekend. Oh, those are fun weekends too, with a cooler full of beer and a stack of pizzas. I remember those days, but hopefully that helps. 90 days, and then the credit report needs to be refreshed. What else do we have, Don?
A question from Danny. My insurance company just jacked up my premium. Can I change insurance companies even though my insurance is part of my mortgage? Who do I call?
Hey, that's a great question, Danny. So here's the thing. Yes, you're not married to that insurance company. And I know it's super confusing because you're making that insurance premium payment each month as a part of your mortgage payment, and the servicer is taking that, and the servicer is the person who collects your payments. They're taking that and they're peeling off that little piece of the payment and putting it in an escrow account to pay your insurance. So you can do it at any time. The easiest time to do it is upon renewal of your insurance, which is usually the anniversary date of buying the property. So if you bought the property on July 1st, then it's easier to organize that now so that July 1st, the new policy is in place, and then the lender can pay that for you with all of the escrowed money that they've been collecting all year. But I'm happy to walk you through that. But who you call, first call an insurance agent to get a competitive quote, and then with the assistance of the insurance agent and the lender, they can arrange all of that for you. It's a pretty easy process, but yeah, man, make the call. And I want to share one thing, and then we're going to get back to questions. We're seeing a ton of people have this same challenge. Insurance rates are out of control right now in Florida primarily. And a lot of people are having this same challenge. And I want to share something. I just had a client the other day who we pre-qualified him, and his insurance quote that we used as a estimate was about $200 a month, or around $2,400 a year. And I looked in the file, and the insurance premium that he had gotten from he's a first-time buyer, so he didn't know. He called his normal insurance company, whoever's is doing his car insurance, his health insurance. Anyway, long story short, I'm not blaming this on the agent, but his quote was $7,500. I'm like, wow, that's $5,000 more than we estimated, and we have a pretty good estimation system. I mean, we do dozens and dozens of these a month. Anyway, I called an insurance agent that I work with for referrals all the time. I send my clients to him. Long story short, the premium was $1,800 a year. So he saved, let's call $2,000 versus $7,500. He saved $5,500 a year by making that additional call. And we actually made it for him. But anyway, I would welcome the opportunity to get you in touch with somebody that can make that significant of a difference for you. And I'm actually working on a segment with some agents that I refer clients to, because we're getting so much call for how to help with lower insurance rates that I think it might become a Mr. Mortgage Show segment moving forward. And I might have an insurance guest at least, once a month, once every other week or something, because we're getting so much questioning about it. So stay tuned for future episodes, because I think we'll be able to help you with the insurance and refer you to somebody that you'll be in good hands with. No pun intended, the good hands thing there. But anyway, I hope that helps. Yes, you can, even though it's part of the mortgage, you're not married to that insurance policy or that insurance company. So let's keep it going. What do we have, Dom?
Mike sent this one in. I'm brand new to this, so this may be a dumb question. I see a house I like on Zillow. Do I call the listing agent? Do I need my own agent? Do I pay more if I hire my own agent?
Hey, Mike, that's a great question. And Dom and I say it every week. There are no dumb questions. And this proves it, because I'm in the business every day. I've been in the business so long that sometimes I overlook these confusions and complexities. And it makes sense. This is a great, great question. So normally, and I'm saying normally because there's no industry standard, but normally your agent, the buyer's agent, will be paid by the listing agent. So typically, a listing agent will put a property on the market, and they've negotiated a gross commission that the seller's paying. And then they agree to share a portion of that commission with the buyer's agent. So in that relationship, your agent doesn't cost you anything. Now, most people prefer to have their own representation, because the listing agent is working for the seller. Now, I know in Florida, most transactions are done, and I'm not going to go off topic here. Most transactions are done under what's considered a transaction brokerage relationship, but they signed up with the seller. So a lot of people like the idea that they have an agent on their side, that they're able to, completely be honest with and ask all the dumb questions. So to answer your question, picking a buyer's agent, or to use your terms, hiring a buyer's agent, costs you, in most cases, nothing out of pocket, and they're typically compensated by the transaction itself in the form of a cooperating commission agreement with the listing agent. So, and if you don't have a buyer's agent, I'm working with some rock stars right now. I'd be happy to get you in touch with somebody. Just give me a shout. 561-291-8569 is the Anytime hotline. But to answer your question, in most cases, having that buyer's agent is not going to cost you any more, and then you're going to have somebody on your side working for you to walk you through the transaction. So fantastic question. That's often overlooked, so I appreciate you bringing that to the table. Let's keep it rolling. What else do we have, Dom?
Daniela just sent in this email. My landlord said he's thinking of selling my building. I'd like to try and buy it. I have never been a landlord or even owned real estate. Is this possible? There are 4 apartments in the building, if that matters.
Hey, that's a great question. And that 4 units, thank you for sharing that, because that's a pivotal number in all of this. But to answer your question, yes, you can buy the building even though you've never owned real estate and never been an investor. And why I got excited when I heard you say 4 units, or I heard Dom read your question and it was 4 units, is because 1 to 4 units we can treat as a primary residence, which means that you can get as little as a 3.5% down payment, 3% down payment, 5% down payment. Those are the varying down payment programs, and buy that as a primary residence with just that small down payment, and stay in the property and then just collect the rent from the other 3 individuals. Now, if you weren't living there as a first-time landlord, you can also use that DSCR loan that we talk about all the time. And in that instance, we're leaning on the rental income from the property itself to support the debt, and we're not even leaning on your personal income in the underwriting guidelines. So I hope that helps. I'm super excited for you, and congratulations on your first property being a 4-unit investment property, because you're going to benefit long-term from monthly cash flow and then build equity in it. So hopefully that helps. If you have additional questions on it, just give us a shout. 561-291-8569 is the Anytime hotline. And Dom and I will be back after this very short break to get to more of your questions. You are listening to the Mr. Mortgage Show. Sit tight. We'll be back in 2 very short minutes. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
As a realtor, I have a bunch of mortgage brokers to choose from, but I prefer to work with Mark and his Mr. Mortgage team. In this crazy market, there is no room for error, especially on the mortgage side. Mark's team moves fast, keeps everybody in the loop, and makes things happen. They always give my clients a great deal and take the time to walk them through every step of the process. When you're considering a lender, I encourage you to talk to Mark Eitel and the Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right. We are back. My name is Mark Eitel, host of the Mr. Mortgage Show. And yes, you heard the man, 561-291-8569. Get your questions on the air right now while we're in the studio. Dom is manning the Anytime hotline, 561-291-8569. We'll get your questions on the air. And speaking of questions, we're going to keep them rolling. What do we have, Dom?
Another text, this one from Crystal. I have an Etsy store and drive for DoorDash and Uber Eats. I heard it would be hard to get it qualified. Is this true?
Hey, Crystal, where is our Uber Eats? We've been waiting the entire show. Dom has that hungry look in his eyes. So, yes, you can, as a gig worker, still qualify. So there are bank statement loan programs where we're using your average monthly deposits as an alternative form of income verification. Or if you're one of those rare exceptions that claims all of your income on your tax returns, we can go that route too. So, yeah, there's even some 1099 programs out there where we can use 1099s instead of W-2s. But, yep, we can help with that. So give us a shout, 561-291-8569. 8569? 291-8569. I had a senior moment, but yeah, give us a call if you have additional questions. Let's throw it back to Dom.
Kevin sent this one. Last week you talked about adjustable rate mortgages. I checked out your podcast. Can you explain the cons of an ARM? The podcast was great.
Hey, thanks for that, Kevin. And yeah, let me throw that out there. Let me push everybody to the podcast. So each day we're doing a deep dive on one topic, and Kevin's mentioning the podcast around adjustable rate mortgages. And you can check that out at themrmortgageshow.com. And there you'll find the daily podcast episodes and then the full episodes that we do on the radio each week. They're recorded and put there as well. So a full library of the nonsense that goes on during the podcast and the show. But yeah, to answer your question, so let's talk about the adjustable rate mortgages. And when I say that, I almost see the wince in your eye because I know everybody is afraid of adjustable rate mortgages because of the bad rap that they got during the boom and bust cycle of the early 2000s. And those were primarily adjustable rate mortgages that led to that. However, they were very, very different. And I'm not going to go into all of the things that they were because they were dangerous. But what the adjustable rate mortgage of today is, it's a fully amortized loan, meaning you pay principal and interest each payment. It's fixed for a period typically of 5 years, 7 years, or 10 years, and then it starts to adjust. And the way it adjusts is typically annually, sometimes every 6 months, but each adjustable rate mortgage is tied to an index. So it used to be the cost of fund index they were all tied to, and then the LIBOR index, and they're all moving to the SOFR index now. But you take the index of that particular reporting period, and then you add a margin to it. And the margin, let's say the index is 2% and the margin is 3%, the loan would adjust at that period to 5%. So the cool thing about an adjustable rate mortgage is they can go down too. So a lot of people who took these 3, 5, 7, and 10-year ARMs during the height of the craziness, interest rates went down from there and their payments went down. So, and then they're capped. So no single adjustment can move more than a predetermined amount. And then they can't move for the life of the loan over a predetermined amount. So hopefully that helps. I'll be happy to walk you through any additional information that you need on that. But ARMs of today are no longer the dangerous ARMs of yesterday. And that podcast episode, for anybody who wants to check it out, is titled Skip Leg Day. It's time for ARMs. And we dive a little bit deeper on how to use those in a higher interest rate environment. So we had a ton of great questions today, and I want to thank you all for jumping in and participating in the show. It's always our goal to give you the information you need just to kind of exhale, throw the headlines off to the side, and look at the real data. And we do this each week right here, same time, same station. If you want to catch up with us during the week, I encourage you to visit the Facebook page. Go to Facebook, search The Mr. Mortgage Show. Will pop up. We post a ton of important and timely data there every day. And then you heard me talking about the podcast. We're having a lot of fun with the Daily Dose. That's available each day at themrmortgageshow.com, or check out the website, www.mr.mortgage. That's www.mr.mortgage. We will be back next week right here, same time, same station. Have a great week.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.